And it just keeps becoming more and more of an increase. So it is a perfectly valid trade to take any kind of volatility increase from an RGL. That's I suppose the point of RGLs is that they are volatility compressions, and therefore you should always be able to make money when the volatility compression breaks. Now, where that break is obviously one of the big questions. In the olden days, a lot of people who traded bonds used to do this very same thing. So when the bond market opened, they would put a buy order 4 ticks above the open and a sell order 4 ticks below the open, knowing that bonds from the open would run one of the two trades. And generally, as a rule, because you're 8 ticks apart, that obviously gives you an idea about where the trade is located, right? Hold on a second. Okay, so in the bond market, the first candle is the 1320 candle that you're always looking for. So when you're looking at the 1320 candle, this is the first candle that's going to have the volume. Now, obviously, the idea is that you're generally, as a rule, trading the first rejection of something. Now, obviously, we've got a prior high up here, which could be a nice breakout location for you there. And then we've got the open itself, which is at a price of 0.8s. Now, 0.8s to that breakout is around about 6 ticks. So it's a little bit more than the usual 4 tick range that we would normally look to trade inside of. But here's how the trade would have worked out. If I looked at this closing price here and this opening price here of 7s. So if the opening price was at 7s, I could put a buy stop order in at 11s. Now it only trades a high price eventually of 12s. It doesn't go very far, but as I said, the idea was we were selling the highs anyway. So you don't take a breakout trade if you're going to be selling it the second you've got it on board. But anyway, as it transpires, the way you would trade this, of course, now is that you would use this. If you are now looking at only bearish trades, you would now trade this as an RGL trade here. So if you trade this as an RGL trade here on bonds, you would obviously now have this area here for your new RGL. Sell side below, buy side above. So obviously your original trade would be the sell here. You'd obviously have made some nice money. You would have scratched out. You'd have sold it again here, and you'd have extended the range. And that would have been it for the day. That would have been you trading for the day just there. That's your extension of the initial range just there. And obviously from that point onwards, you now have new RGLs like the US Cash Open, which is always a new RGL, which is at 2:30. And obviously into the Cash Open, we know that bonds have a directional bet coming in again. There's the US Cash Open there, again 4 ticks. The price rejects at the lows here at 18s. That gives you a first rejection, so you're now long bonds coming in here, and there's your next trade. And that's obviously another bond trade that goes on to make nearly, obviously, $1,500, which is a great trade outcome for anybody trading the Cash Open on bonds. Well, the same is true of any market. It doesn't matter whether it's oil, because the NYMEX Open oil prices go ballistic, and we know that from 1400 hours, there is going to be a range extension. So if we know there's going to be a range extension at exactly 1400 hours on the dot, guess what happens? Well, we set up perhaps a little breakout narrative on this. So there's the 1400 hours candle coming into view just there. There's the open right there. There's the first rejection right there. You're looking for your breakout trade, so you could put your breakout maybe at 92s. I wouldn't like to put it above the zeros, because there might be commercial sellers come straight in there. So there's your first trade narrative there on oil. And obviously that's it. You're off and running. And that trade goes 90s to a high price of, well, you can see a high price of 90s up to a high price of 80s. 3 minutes. 3 minutes at the cash open of oil, guys. And now, oil is probably as volatile, if not sometimes more so, than the S&P. So you've got to be prepared for the fact that you just made nearly $1,000 in 3 minutes per contract at the cash open. And obviously this becomes a buy side, sell side area, and you can see that we drop through this area here and we extend the volatility to the downside of oil from that very, very nice break there. And that goes 108s to a low price eventually of 106s, $2,000 to the downside, $2,000 to the downside. So, you know, volatility breaks are a great way to trade, which is why we teach the RGL concept. You know, the idea of the RGL concept, not that anybody ever trades the damn things, but, you know, if you're trading volatility expansion, it's a great way to make a living. It is a great way to make a living is trading volatility expansion anywhere. But there's a lot of different ways you can trade it, depending upon how fast you are, depending upon how fast your platform is, because your platform might not support that type of speed of trading, because there's even a fraction of a second lag inside of volatility breakouts can cost you a fortune. So inside of a volatility break, you might be saying, how the hell can I possibly make any money on these, because it's too quick. By the time I'm getting ready to take my fill, the price is already gone. So when you see volatility breakouts, you're obviously trying to figure out what it is, how you're going to deal it. Get some references, get some areas that you want to trade from. The way I like to trade these is I like to trade the first rejection. What's the challenges to the first rejection? There might not be a first rejection. You know what I mean? So what do I mean? I like to trade the first rejection. Well, I'm a bit of a cynic, and you know, and I think that the market generally, as a rule, goes in the wrong direction first before it goes in the right direction to get stops. Okay, so the market, through 40 years of experience, the market generally, as a rule, if the market's bullish, generally as a rule, they'll run this direction here, and then they'll do that. And obviously, if you're trading the first rejection, that's your first rejection trade there. And you buy into that as a first rejection. Now, sometimes, of course, they don't do that. Sometimes it goes south, it just keeps going, in which case you haven't had a chance to join in. But if for that to happen, there's usually been a story. There's usually a very, very strong storyline in the background waiting for this to happen. So if they do this, then I trade the next rejection. So if I trade the next rejection, that's the next rejection just there. Still trading volatility expansion, correct? So when that rejects, and it does that, you trade the next rejection. Still volatility expansion, right? Still volatility expansion. And guess what? If it does that, you trade the next rejection. Still volatility expansion. It's not going to do this all day. It's not going to do this all day. Now, you don't just choose one single price. You start outing the range a little bit. You take it a little bit wider, and then maybe another extra tick wider through that phase there. And then you take it another tick wider through that phase there, just to give yourself a bit of space and a bit of capacity to put a trade in and ask for a little bit more from it. And then you're in the trade. And that's what happened to the S&P this morning. It rejected, traded higher, lower, higher, and then gone, sell side. So it traded basically this pattern here. So it opened here, and it traded higher from the open. It traded lower, it then traded higher again, and then it was gone. Okay, so that's not a lot to trade into. That's not a lot to try and figure out. The only trade I'm not willing to take is a breakout expansion here, unless I have an incredibly bullish value line. If I'm going to trade that as a breakout trade, if I like the idea of trading that, I should be in the trade here as a volatility squeeze. In other words, I should trade the BSG squeeze. So in other words, find the prior high and put the buy order in 2 ticks before the prior high. And the same for the sell. I don't want to sell below that line. I want to try and sell 2 ticks before the prior line. Does that make sense? Okay, so let's analyze the S&P again. Okay, so if this was the S&P open here, and the price opens, starts trading towards the red dots, then I already know where the red dot price is. It's at 30 evens, right? So I could put a buy order at 29.5 for a buy stop. 29.5, right? So I could trade 29.5s, buy stop order. And obviously I would have been in for the BSG squeeze. Now if it takes off, I'm in it. If it doesn't take off, and we come across a commercial seller coming in here, I'm already going to know that because the price will come back into value here and scratch me out for +1 or +2, right? So they'll come back into value there and scratch me out for +1 or +2. So I've already got that 2-tick cushion as it comes back to the price. You might be saying, but what happens if? What happens if it just scratches me out and goes straight bullish again? Well, you've got a new red line at the top edge, so you could put a buy stop order. The new red line was at 31.25. You could put a new buy stop order at 30.75. So there's your new buy stop order right there, right? So obviously the price doesn't trade there. It trades back down and through this area. There's the blue line at the bottom edge. So the blue line at the bottom edge there was at 28.25. So you could put yourself stop order at 29.25, couldn't you? Sorry, not 29.25, 28.75, right? 28.75, sell stop order. So there's your sell stop order right there. And obviously you run some beautiful play to the downside. You're in at 29s, 28.75. You trade 25.75. The price doubles back. You've now got your buy stop order there. And you've now got your sell stop order here, right? Whatever happens, you're going to be involved in the volatility expansion. So the buy stop order here, it goes up. And guess what happens? When it comes back to the value line, when it rejects there, you make a zero. You literally make a +1 or a zero. On this occasion, probably a zero because it never gave you much on the upside. So you probably wouldn't have even had a chance to move your stops into the red line itself. You're trading 2 ticks before the red line, remember? And that's you're flat. So you might be saying, but where do I go again? Well, there's the new red dots, 31.75. So your new buy trade would be 31.25, right? Your new buy trade would now be there. Your sell trade is there, so what happens? You get taken into your short trade there. And obviously that short trade is the one that absolutely annihilated the downside, yeah? So you'd have traded 3 times. You never lost any money on any of these 3 trades, these initial 3 trades. And then your 4th trade, you make thousands of dollars. And that's trading the BSG squeezes from the volatility breakouts. 2 ticks off the high, 2 ticks off the low, and just keep widening the bracket until you're happy with the value, until you're happy with the shapes and forms that are forming. And your last sell trade was at 26 halves. And as I said, by the time the price dropped into a bottom edge, you were trading at 4s for $1,000. So that was your volatility expansion from that. But you had to do a bit of work in here, right? You had 4 trades in a period of 1 minute, 20 seconds. So you have to be very, very, very switched on. You have to be ready for the fast money stops into break evens. You have to be ready for the fast money buy stops and sell stops to be put into place. That's part of course of the what? That's part of the Monday Club. So we'll cover that in the Monday Club as well, since we're going to be covering Delta as well. We'll do this in the Monday Club. We'll do volatility expansions without any type of value lines. We'll just try and make sure we're in line for these volatility expansion type trades. Alrighty, all good? Remember, the same can be true of these wholesale price levels. Remember, it's not just about volatility expansions on the cash open or the cash close. It's also true of things like wholesale price levels. So for example, at 30, 39, if you're liking what you're seeing at 39, you can obviously start looking at it from this area here. So for example, you can see that on this occasion here, you can see, right, I've got a balance area forming at 39 here. I want to be long, but I don't know where to get long. So where would your volatility expansion be? Well, there's the red line there at 1.25. So 75 would be the right volatility expansion trade. So there would be your BSG squeeze right there, yeah? So there's your BSG squeeze. If you're very, very bullish that this market is going to pop, there would have been a BSG trade 2 ticks ahead of the popping level, and then the price pops. You've just made a very, very nice volatility expansion trade right there. Yeah? Pretty good? Well, we'll practice it in classroom and this afternoon. We'll practice it in classroom this afternoon.